Hello, everybody, and welcome to the Like a Tortoise channel once again. I hope you are all having a fabulous week so far. Hopefully, it will continue as we have the new year just around the corner. But so today, first of all, thank you so much once again. I always mention the same things, but I can't emphasize how much I appreciate all the support that you guys have been sharing with me. So thank you so much for all of that. Some of you already mentioned in the comments a few names that you would like me to discuss, some companies that you would like me to break down in further videos. And I will gladly do so. I've been noting down some of these names. Some of them I know they are quite familiar to me, and I know that I wouldn't invest in them because they just don't meet the criteria for quality. But we will talk more about that in future videos. Okay. For now, I'm just noting down the names of those companies, and I will post more videos on them going forward. So if there is any company in particular that you'd like me to talk more about, just leave the names in the comments below. Okay. All right. So today we have a special episode, and why I say that is simple. It's because if you are a fundamental driven investor, then there are certain data that you have to analyze. And one important report that I always like to analyze whenever it comes out is the one that is created by JPMorgan Asset Management Group. And this is just pure gold for a channel like a Tortoise. And the reason I say that is because even though we are not macro analysts, right? So we are bottom up investors. We look at the company fundamentals first, but we like to have a high level understanding of what's happening on a macro level, because we like to educate ourselves. We like to be in the loop. Okay. And it's important to have that a broad understanding if you want to become a better investor. Always learning, that's the goal. So if I click on the guide to the markets, and this is something that you can all have access to as well, so just follow me onto this page. Then what happens is, let me just minimize this. This is just pure gold, guys. Again, this is something. The last one was released on November 28th, 2025, which wasn't that long ago, but it's just pure gold because of the data that it contains is so rich, and I will walk you through the main findings, and hopefully that will drive home many of the things that we've been discussing here on this channel over the last several months. All right, so let's crack on. Specifically, you can see that there are different parts to this report. I think the most important one is equities, and this is the one that we'll be starting analyzing. I'm going to try to be as succinct as possible and just walking you through the essentials. But I mean, everyone watching this can easily access this. So if you find it insightful, just go to the page and just download the report. Okay. So let's crack on right here to equities, and there are a few data points that I want you guys to pay attention to. Let's start with this. You can see the S&P index at inflection point. So you can see we have the year 2000, 2007, 2020, 22, and now recently 2025. And what you can see is that based on a forward PE multiple, the index is currently at one of its highest valuation levels in history, only below the 2000 levels. Okay, you can see that the difference is not that big, and sure enough, the dividend yield is at one of its lowest levels in history, which is, I mean, it's insane. Okay, so it goes to show that yes, based on this metric, the S&P is definitely at very rich valuations, and this is something that most people that keep pouring money into the index have no clue of. It's just outstanding to me that they continue to fall into recency bias, believing that the next 15, 10 years are going to be just as impressive as the last 10 years, which is ridiculous. But let's crack on. Look at that. Here you can see, for example, exactly what we were discussing in the previous slide. Look at that, right? So the P forward P currently sitting at 22. Look at the 30-year average, about 17. Okay, this is where we sit. Based the CAPE, which is the adjusted Shiller P, is currently at 40. Yeah, and the 30-year average is at 28. Many investors pay attention to the CAPE because it's cyclically adjusted. Look at the dividend yield. Okay, latest is 1.4. The 30-year average is 2%. And it's just incredible. Okay, so very, very pricey, to say the least. And sure enough, and this is what I will start showing to all the people that so blindly believe that the next few years are going to be incredible, what they miss out on, what they miss is that every time you have these high levels of valuation, chances are that the next year's returns are going to be muted. Okay, and this is what JPMorgan is saying here. So let me break it down for you. Look at that. Forward P and subsequent 1-year returns, in forward P and subsequent 5-year annualized returns. The forward P currently sits at about 22 times, right? That's what we saw right here. So the forward P is currently at about 22 times earnings. And what you can see is that when the forward P is at this level, the subsequent 5-year annualized returns are around zero. Zero. Okay? And it makes complete sense. Why? Because you are buying into a very pricey market. A lot of the good news are already priced in, and chances are, if something doesn't live up to the very exuberant expectations, then the markets will tumble, and they will not tumble 1 or 2%. They will tumble 20, 30, 40%. Okay, and this destroys these like subsequent 5-year annualized returns, which is exactly what we are seeing right here. And as a matter of fact, I also believe that the next 10 years, not just 5 years, will probably see returns around 3 to 4%. And that's already being a bit optimistic, if you ask me. Okay, so very important chart. This one right here, no, I don't think it's that important. This one is key. Look at this, S&P 500 index concentration, the P of top 10 and remaining companies in the S&P 500. What have I been saying? I've been saying, and I've shown you data that emphasizes this, that the S&P is currently, the Magnificent Seven, so the biggest 10 companies by market capitalization, are driving most of the S&P 500 returns, as we will see in futures in the next slides. But they are also contributing to the very high valuation of the whole index. Okay, look at that. The top 10 companies, the latest P is around 29 times. But if you strip those out, you can see that the remaining companies already have a P of about 19, okay, which is a lot more conservative. Okay, so for those of you guys who have been pouring a lot of money into the Magnificent Seven stocks, watch out. Okay, because price is what you pay and value is what you get. Be rational. Don't fall into recency bias. I discuss human biases at length in one of my previous videos, so make sure you watch it, because I think it's very telling. Okay, and look at this, the weight of the top 10 companies in the S&P 500. Look at that, top 10 market cap, top 10 earnings. So the weight is also incredible. And in fact, what's even more astounding, guys, we will talk about that when we get here to the top 10 companies by decade. Look at the performance of Magnificent stocks. They have been stellar performance. Look at that, since 2021. Look at the share of the percentage of the returns. 33%, 56%. They even contributed 63% in 2023, and now they sit at about 45%. So they are the most expensive ones, but they have also contributed most of the S&P 500's gains. So, I mean, you can make that case. However, bear in mind that this earnings growth is declining. But however, valuation multiples haven't come down enough, because what we are seeing is, yes, they were the biggest contributors to the S&P 500 gains. However, what we are seeing right now is that contribution has been coming down, because I mean, right now all these big tech companies are investing aggressively into AI, without, and of course that will compress the that will affect the margins, because we don't know when we're going to see returns on that invested capital, right? So earnings growth is coming down, but the multiple hasn't come down enough yet. Okay, so take that into account, because it's important. On the other hand, look what happens to the unmagnificent seven stocks. Look at that. They were negative in 2022. They were at 11% in 23, and now 14% in 24 and 14% in 25. So they are actually going up. All right. So, okay, cool. Top 10 companies by decade. This is staggering. And what you can see, I think this is incredible. Never ever before in history has one company had such a big weighting in the S&P 500. Okay, never before. In Nvidia alone is it has well, it has a weight of about 8% in the S&P 500, which is staggering. Okay, so this has never happened before. And in fact, look at this, right? Top 10 S&P 500 companies by market capitalization at the beginning of the year. You have 1985, 1995, 2005, 2015, and now 2025. And what you can see is that these big tech companies have so the largest 10 companies today have the biggest weighting in the index, which is very dangerous if you ask me, because if you believe in the reversion to the mean, as I certainly do, then chances are that sooner or later the pendulum will shift to the other side. And when that happens, I think if when these companies come down, all right, they will drive the whole index down with them, exactly because it's market cap weighted. Okay, look at the value versus growth valuations, right? Another key insight, another very important data, and it shows you that the discrepancy, in fact, it shows you that value relative to growth, value companies have never been this cheap relative to growth, going back to many years. Okay, so there is definitely opportunities in the value space. You can see that the latest P is about 17 times, and look at the long-term average of 14 times. So we are just hovering around the average, the long-term average. So value stocks are very cheap. Look at the growth stocks, very expensive, almost 30 times, and the long-term average is 21.4. Okay, so very expensive. Very important here as well. Let's have a look at valuation dispersion. No, I don't want to discuss that. What else do we have here? Percentage of market capitalization by sector. No, what else did I check? Nope. This also is not interesting. What else do I want to talk about? Let's have a look at unemployment and wages, which I think is important. I mean, there's so many things that we can discuss, but we will keep it short. We will try to keep it short and try to really drive home the most important findings. So look at this: civilian unemployment rate and year-over-year wage growth, something that I like to pay attention to. Back in 2020, unemployment rate as you can see, was really high at about 14.8%. This was a black swan because of the pandemic. Right now, I mean, it remains low, certainly if you compare it to history, but look what happens. It's been going up. Okay, so it's a trend here because it's been going up since 2022, as you can see. So it's something to keep it. Well, ultimately, if unemployment rate goes up, that will affect all sectors of the economy. So we should keep an eye on that. But yeah, and look at wage growth. So the unemployment rate is going up, and you can see that the wage growth has been going down sharply since 2000 since its last peak at 2020. Okay, in 2020. Let's also consumer finances, something interesting to take a look at. For example, look at the household debt service ratio, also going up since 2020. Okay, so it's been going up. Look at the flows into early delinquencies. Look at the auto loans, credit cards, student loans. Look at that. Student loans has been exploding since the end of 2024. Okay, the other ones, mortgage, credit cards, and auto loans remain stable, but certainly the student loans have been just exploding. So something to bear in mind. And in addition, and why I remain so constructive on international stocks is exactly because of this, everybody. If you have been following the channel, you know that we have been, in fact, there is a reason why our largest allocation is actually a Chinese company, as you all know, Alibaba. And look at that. Look at the share of global market capitalization. The US has never had, so since 1980, since 1987, the percentage, right? So the global weighting of the US market has never been this strong. Look at that, 65%. And if we compare that to the emerging markets, look at that, only 11%, Japan 5%, Europe, with the exception of excluding UK, about 11%. So the global market capitalization is tilting heavily in US favor, and I believe this will change. Okay, I believe that again, reversion to the mean sooner or later will happen, and when it does, you will see that that percentage of US to come down, while the other ones will go up. And we saw this, for example, in we saw this for example in 2000. In fact, if I show you right here, look what happened. Right at the peak of the 2000 tech bubble, you can see that emerging markets significantly outperformed the US markets. And I think we will see something similar, which is why I'm very, very bullish on international stocks. You can find still great value companies at great valuation levels, which is something that I really like. Okay. Okay. So let's. What else do I want to discuss here? Uh, ta, ta, ta. Let's have a look. Global economic activity, alternatives, investing principles, asset class returns. Right here. Time diversification and the volatility of returns. No matter what happens, guys, if you have a long term mindset, chances are you will make a lot of money in the stock market. Another thing that I keep pounding the table on this channel. Take my word for it. If you look at this. Time diversification and the volatility of returns, range of stock, bond, and blended total returns. What it shows you is that the longer you stay invested in the stock market, the higher the probability of making money. Look at that. So, and this happens across all different asset classes. So, in fact, if I go here, you can see, let me have a look. Yeah, exactly. So, for example, look at the 1 year returns for stocks. You can see that the range is between minus 37 and 52%. So there is a high probability of you losing money as well. But then look what happens as your time frame widens. right? As your time frame, so as you lengthen your investment horizon, look at that. If you hold stocks for example, for a 5 year period, look at that, between 29% and minus 2%, and then look what happens 20 years rolling. So you will get, if you hold stocks for a 20-year period, chances are that you will probably achieve between 6% and 18% annualized returns. Okay, look at that, no negative returns. So the longer you stay invested, the better. So no matter what happens to the economy, if you do understand the companies that you are investing in, and if you have an owner oriented mindset, yeah, in which case you will be adopting a longer term approach to investing, then you will be very successful as well. Okay, cool. So this economic and market cycles, manager dispersion. I don't want to discuss that. Yeah, these were the main things that I wanted to talk about, guys, and it's just very telling. So yeah, I hope you managed to learn from it, because whenever they release this report, I'm always looking forward to delving deeper into it, because I mean, again, it's pure gold. Okay, and so I hope you managed to like it. Just smash the like button if that was the case, and let me know. Give me ideas. What else do you want me to discuss? And I also want to emphasize that on the 31st, I believe, is it the 31st? Let me see. Is it January the 31st? Yes, it is, which is on a Saturday. We will have another live event. So the first one went really well. I really enjoyed some of the questions that you guys brought up. So if you didn't have the chance to join, we will have another YouTube live chat, another live chat on the 31st of January. So yeah, just make sure to not miss out on that, and stay tuned for more.